For all your news, advice and product information, visit MoneyExpert.com. Hello and welcome to MoneyExpert TV. I'm Esther Shaw and I'm joined today by Andrew Montlake from broker Cobalt Capital. He's here to talk about some of the latest developments in the mortgage market. Hi there, Andrew.
Hi.
Thanks for coming along today.
Pleasure.
Now, first of all today, we're just going to look at some of the latest stories making the headlines. Now, one really interesting story that I've picked out is this one with the headline, Advisors Slammed in Which Expose? Now, this looks at this latest undercover investigation by consumer body Which into the advisor community. And it found in its investigation that only 4 out of 50 experts gave what it calls acceptable advice to borrowers. Now, Andrew, what do you make of this? It seems a sort of phenomenally low figure of people giving acceptable advice.
Well, advisors always seem to be slammed for something or other at the moment. I think it's difficult to know. I think Chris Cummings, who's quoted in the article, makes a very good point.
And he's from the Association of Mortgage Intermediaries.
Yeah, when he basically says that a lot of the people that they probably interviewed or tested out were salespeople, so they would direct sales force from banks or tied advisors, not necessarily the independent mortgage brokers who, well, it says 3 out of 4 there have actually been shown to give good advice. And it's those types of independent brokers who I think people should more and more go and see. Thanks
very much. Moving on now, there's been an awful lot of doom and gloom in the mortgage market over the past few months as households have tried to deal with increased mortgage costs on top of rising food bills and fuel bills and so on. But now what we're seeing is a bit of a change and a bit of an improvement in the mortgage market. In the last few weeks, we've seen both Nationwide and Halifax and a whole host of lenders actually decrease the rates on some of their mortgages. Now, what do you make of this, Andrew? Is this a sign that the mortgage market, that we're turning a corner?
I think it's too early and too optimistic to say we're turning a corner yet, but it's refreshing to see lenders like Abbey, Nationwide have followed suit as well. The whole HBOS group, which is Bank of Scotland, Halifax, Birmingham Midshires and Intelligent Finance, as well as Woolwich, actually cut their rates. So that is very encouraging news, and that's a useful shot in the arm to advisors and ultimately the customers as well.
Because prior to that, we'd seen rates going up almost on a sort of weekly basis, hadn't we? The liquidity in the market was drying up and we were just seeing rates sort of escalate.
Yeah, I mean, the issue with the credit crunch was the cost of borrowing between banks. So LIBOR rates, the London Interbank Offer Rate, was artificially high because lenders didn't really want to lend money out. They didn't want to lend money to each other because A, they thought they can't trust who they're lending to, and B, they needed the money for themselves.
Now, we have actually seen swap rates, haven't we? Now, and fixed rates are dependent on swap rates, aren't they? We've seen those rates drop, but yet lenders have taken quite a while to follow suit with that, haven't they?
Yeah, because of the issue with the LIBOR rates, that's taken a while to unfold. The good news is that we've seen, as swap rates have come down, lenders still need to lend at the end of the day. They still have to lend to make money, and they still have certain targets to fulfil for the end of the year. So as the market has found its own kind of balance, its own equilibrium, if you like.
Stability there, isn't it?
Yeah. And so now we're seeing the benefits of that period of stability.
For borrowers looking to take out a mortgage now, is now the time to fix, or is it time for a tracker?
My belief is that I still think fixed rates are still suffering. They're still artificially high. If you look at the difference between a fixed rate and a tracker rate, there's still a difference of between 0.5% to 1%, which is quite a big difference, which means that to lose out on the tracker rate, rates have to rise by 3, 4, even 5 times before you start losing out. And I don't think in this market, certainly short to medium term, we're going to see that. In fact, we might actually see the Bank of England base rate reduced slightly. So it does depend whether or not the applicant needs security.
We talked a bit about stability and a bit more sort of positive news in the mortgage market, but I think the burning question is, are we going to see this much talked of housing crash sort of avoided now?
Well, I don't like the term crash. Correction, I think, is more appropriate, and that's been coming for a long time. Let's face it, it's the rises we saw were unsustainable, and so we've seen this house price correction. I think in some areas 10, 20, even 25% is not going to be unrealistic. But I think what you've got to counter is supply and demand. And I think the flip side is once we start to ease our way out of this, I think you'll see a bigger boom in house prices than we've actually seen in recent years.
Thanks very much for that, Andrew.
Thanks, Esther.
Moving on now, it's competition time. If you fancy yourself as a bit of a money guru and want to win one of our Money Expert mugs, then all you need to do is answer this simple question. What does LIBOR stand for? Is it A, Level Interbank Offered Rating, B, London Interbank Offered Rate, or C, London International Open Rate? Send us your answers to quiz@moneyexpert.com. That's just about all for this week. I'd just like to say thanks very much to Andrew Montlake from broker Cobalt Capital for coming along today. Thanks very much, Andrew.
Thanks, Esther.
And to say, do join us again next time on Money Expert TV. Bye for now.